Welcome to Stock Talk with Mike. In this video, I'm going to walk you through my portfolio overhaul process. This is going to be part 1 of 2, looking at the top 10 of my 22 holdings in my portfolio. So as far as investing goes, the majority of my time is spent researching companies, both companies I already hold, as well as new opportunities. And that's what the majority of my YouTube content is created around as well. But twice a year or so, every 5 or 6 months, I like to do a bit of a portfolio overhaul or a portfolio review, go through my holdings and make some decisions that are gonna kind of direct my strategy as far as any little adjustments I need to make over the next 6 months moving forward. All right, so let's get into it. For my portfolio overhaul reviews, I'm typically looking at 3 things. I'm looking at my position size relative to my entire investment portfolio, my valuation of these stocks, so just a really high level, looking at price to sales, forward PE, and then that in relation to revenue growth. And then I'm also looking at short-term stock performance. How has the stock performed over the last 6 months? Because that might give me some indication of any near future sell-offs or profit taking that might occur in the company as well. Okay, so for position size, generally, I'm not looking to let a single position be more than 10% of my total portfolio. Typically, a position being about 5%, I consider being fully built out. Let's get into largest position in my portfolio currently, and that is Square, ticker SQ. Its position weight is 8.4%, so I like that my largest position is under 10% currently, so no concerns there about overweighting from single stock risk. As far as performance, it's up 26% since I did my last review 5 months ago. And looking at this stock chart here, it's 50% off the May lows of 180. So it's made quite the run in a short amount of time, which always gets me a little bit worried when you have these quick short-term moves. But looking at the valuation, it's currently trading at 6.5 times sales and a forward PE of 117.5. So traditional valuation metrics for Square are always a little misleading now that they are required to record Bitcoin transactions on the revenue line. So I sound like a broken record. I mentioned this on a number of Square videos. But when someone on the Cash App buys Bitcoin, say they buy $5,000 of Bitcoin, that entire $5,000 shows up on the revenue line. And then majority of that, of course, is expense because the margin on that is minuscule. I think they're actually even losing money on that right now. But that's not, in my opinion, really full revenue, right? It's kind of like a brokerage every time someone buys a stock on it, recording the full investment amount rather than their commissions, right? So it doesn't really make a lot of sense, and it really has caused the revenue growth number to be inflated as well. But if you back out the Bitcoin sales, their price to sales is still around 15, so on the high side then, but given the high growth rate of 100%, I'm relatively comfortable with the valuation. I tend to give companies a very a lot of leeway as far as valuation as I do invest a lot of growth stocks, and I'm not looking to get in and out of positions. Next, my second largest position, around the same weighting, again about 8.4%, but slightly less in this stock. It's Airbnb, ticker ABNB. So, that name is obviously pretty well known for their short-term rentals that are just disrupting experiential accommodation industry as a whole. I do like Airbnb for its long-term prospects. And of course, here's my second largest position. It's down about 9% in the 5 months since my last review, but up 21% off the May lows. And I've been building out this position at these lower levels that we saw in June through July. So this is a company that I've been actively buying as of late, and definitely fully built out here. I don't think I can really add much more at these levels. I got to give it some room to run to the upside. So definitely fully built out, and given a lot of opportunity to buy, it definitely hasn't been going anywhere over the last several months. Price to sales at 17.4, again, not cheap, with a forward PE of 395, which is extraordinarily high, But like Square, which also has a high PE, it's basically that these companies are just barely gone from non-profitable to just barely eking out a profit. So you get these crazy high PEs, which are high by anyone's standards. And relatively high growth Airbnb, a very high growth Airbnb is 69%. And I think coming out of the pandemic, we're going to see an acceleration in growth in Airbnb. So I'm again comfortable with the valuation overall with Airbnb, although it is on the high side, obviously, generally. Next, my third largest position in my portfolio, Unity Software, ticker U. It's got a 7.7% weighting in my portfolio, and it's up 40% in 5 months since I did my last review, and 75% off the lows in May. I didn't quite catch it at the bottom, but anytime I saw this stock drop below 100, definitely in the 90s and even some in the 80s, I had been aggressively buying and then built out this large position after having positions since shortly after they went public in 2019. So yeah, definitely happy I built it out, and it's performed very well for me over the last little while here. And 35 times 2021 sales. So I should mention my sales calculation, I'm basing it on what's expected the full year here of 2021. So it is providing a bit of a favorable valuation, because typically you go on Yahoo Finance or whatnot, you're looking at trailing 12 months. But I want to be forward thinking here and see where the company's going. And with these high growth rate companies, you can see at a like Square at 100% growth rate, obviously that price to sales is going to come in really quickly, because if the share price stayed the same and they had 100% growth next year, it'd go from 6 to 3, right? So anyways, they're not profitable, so no forward PE on Unity, and the revenue growth rate is expected to be 37% here for 2021, kind of growing in that 30 to 40% range. So as I mentioned, I give a lot of leeway as far as evaluation, but I've marked this one in red. Because by any stretch of the imagination, Unity is trading very rich, in my opinion. And with that comes a higher risk of heightened volatility moving forward, is more likely to people to ring the register, or at a sort of a risk-off environment. These are the companies that tend to sell off the hardest. So not only is it trading expensive, but then it's also done a big run in the short term, 75% run in about 3 to 4 months. So although it's a very long-term hold for me, Unity, and I didn't mention this, but just being the leader, the 3D engine for all things metaverse, right? Gaming, education, film, engineering, construction. They're not just gaming, and their future is not just gaming. I really like their prospects for the future, and I have very high conviction in Unity. But that being said, based on the number of high valuation stocks in my portfolio and the movement as of late, I marked this one in red because this might be one I look to trim a little bit if we continue to see extended strength in this name, and just to lock in a little bit of profits that, it's run a lot this year from some of the lower bases I've been buying at. And I will look for future sell-offs of 20% or more to add back. So any weakness, just kind of building back out that position. Not looking to completely sell out of any of these positions that I've marked in red. Just take a little bit off the table. All right, next, NVIDIA, ticker NVDA. So they're the chip maker that's really the forefront. Their graphic processing units, GPUs, are the forefront of a lot of growing and disruptive industries, gaming, AI, autonomous driving, you name it. I think this is the play in artificial intelligence for sure, and gaming. NVIDIA has just been a phenomenal investment for 5, 10, 15, 20 years now, and I see that continuing for years to come. It's the fourth largest position in my portfolio at 6.4%, and it's up huge, 78% in the last 5 months. There was a 1-for-4 stock split in there, and this is another one of those stocks that I added in March when we saw some weakness, and done incredibly well since then. It does trade at 22 times sales, which on the surface is very expensive, but it's incredibly high margin business. So even at 22 times sales, it has a forward P of 49, which is still very high, but not nearly as high as when you see at face value a price of sales of 22. So it is very profitable. So because it's very high margin, I could mark this one as red, but I'm not, because the high margin and given the very high revenue growth rate, 54%, and it's a cash cow machine, I'm willing to give it a lot of leeway and valuation. It's kind of on the fence here, on the verge of me marking red to potentially take some profit. So if I see 100% upside from where I was adding to this position in March, so if we see 100% upside in less than a year, I would definitely be looking to trim. So we're not very far off those levels where I would be potentially taking some off the tables, but I'm gonna leave it for now at these levels. All right, next we have my fifth largest position, C Limited, ticker SE, Singapore-based Southeast Asia e-commerce, digital entertainment, so gaming, and digital wallet company with C Money. 6.1% of my portfolio is in C Limited. Also a huge run in the last 5 or 6 months, up 69%. This is yet another position I added to a March weakness, using up all my dry powders I mentioned earlier. And it's done really well since then. And it's why it's one of the larger positions in my portfolio currently. But unfortunately, this one gets a red mark as well for valuation, trading at 21.2 times sales, much higher than its historical price to sales ratio, basically double than what we've seen in the last few years, despite the huge revenue growth of 105%, just massive growth. And given the run it's had in relatively short term, I just think it's a real candidate to see volatility here in the near future, and I wouldn't be surprised we do see a 20% sell-off, even though I think the general trajectory of the stock's going to be up. I did a video recently talking about where I could see it doubling from here, and that still stands. It's just if we can see continued strength, I'll probably lock in a little bit of profits and take some trimmings, as I expect we will see some short-term volatility that could provide some better buying opportunities for me to take advantage of. So it's just about taking a little bit of risk off the table and locking in some massive upside returns in a short amount of time. And I think that's an important aspect of investing in these growth companies. I think you can do well just buying and forgetting it as well. But just I think for me personally, this is an approach that works for me. All right. Next is Amazon, ticker AMZN. So they're basically everything, e-commerce, obviously. And, I think they don't get a lot of credit that they're really a global play. 50% of their e-commerce revenue now actually comes from international, whether it's India or other markets. So definitely an international play now, and that's going to be a huge leg of growth for them moving forward that I think investors know about, but don't pay enough attention to. Obviously, AWS, their cloud computing is a massive revenue generator for them as well, and they're moving into all kinds of other markets, whether it's healthcare or whatever else. So it's been trading in a bit of a range for several months now, currently up around 14% in the last 5 months, but really it's kind of just been in this trough pattern. And as far as valuation, 3.7 times sales, with a forward PE of 52. I'm okay with the valuation given the 20 to 30% revenue growth we see year after year. Amazon is kind of my version of a blue chip company. It's a core position of mine that I see holding for the foreseeable future. With a 1.7 trillion or whatever exactly the market cap is, I see this as a really stable company that's highly profitable. That is a good core long-term hold in my portfolio. All right. Next is Palantir, ticker PLTR, my 7th largest position at a 5.7% weighting. So they're the big data analytics company using AI that really had contracts with government, now looking to move into more of the corporate world. And they're up 18% last 5 months. Which isn't bad, right? That's a nice solid return. And 60% off the short-lived dip we saw there in May. I didn't fully capture that bottom. It was a very rapid recovery from those lows. But, I did buy at some lower levels, adding here. And mainly kind of sideways, though, if you take that steep decline out. And as far as valuation, now it's at about 34 times sales. Again, barely just planning to just barely eke out a profit. So it's got a very high forward PE of 126.9. Decent growth at 38%, but it's still very expensive, right? When you have a price of sales in the 30s or more, it's really expensive. Anything over 15 is very expensive by traditional standards. So a 34 is expensive any way you slice it. Even with the good growth rate of 38%. So definitely, given that we've had some upside movement on this stock and its valuation, I have to mark this one as red as potentially one to trim from if we see increase in share price over the short term. Next, we have Cpng. I used to say Cpng, but it's actually pronounced Cpng. Ticker Cpng. They're the South Korea e-commerce Amazon equivalent. I think everyone gets a lot of flack when they call anything the Amazon equivalent. And a lot of companies get that comparison. But on the e-commerce side of things, this is the closest thing to the real deal. Very customer centric on their e-commerce front and doing a lot of great things. And it's my 8th largest position at 5.6% currently, down 32% in the last 5 months. And I've been taking advantage of all this weakness to build out this position to this level. Currently trading at 2.7 times sales. So it's a lower price to sales than, say, Amazon. Not profitable. They're investing in their growth and building out their business. But with 60% revenue growth expected for the full year 2021, huge growth, trading at that sales multiple. I actually had to mark this one green as actually an attractive valuation at these levels. Possibly add on any weakness, even though I'm building out a fairly large position size here relatively quickly, as this is a new position for me in Cpng. Really happy with the valuation here. One of the few on here I'd be looking to add on to here in the short term. Next is TDOC, ticker TDOC, the virtual healthcare provider, telemedicine leader by a mile. There's lots of players now in this space, but no one is, even a quarter as big as TDOC or gaining market share as rapidly as TDOC. So that really says something. 9th largest position at 4.9%. So basically a full position here for me, close to that 5% mark. Down 18% over the past 5 months. I think it's been kind of looped in at one of those high-flying stay-at-home plays. That's just a bit of a fad. But I really think that's not true. I think TDOC was growing incredibly quickly pre-pandemic, and I don't think this virtual medicine is going anywhere. Trading 11.5 times sales with that massive growth rate at 84% expected in 2021 and a long history of massive growth. I think that sales multiple is actually pretty reasonable. And I expect they're still paying off that Livongo merger, which was, it was an acquisition, but it was basically a merger. They were just as big as TDOC. And paying that off is really hurting the bottom line. But once that's paid off and this company matures, I think it could be a very highly profitable business. So if this one dropped another 10%, or if that sales multiple dropped below 10%, I'd be marking this one as green as actually an attractive valuation at these levels. But right as it currently stands, I'm holding at these levels and adding if we see continued weakness. But definitely this isn't one I'd be looking to take any profits on. I think we got much higher levels ahead for us in the short term. And on the long term, like I'm a long-term investor, I'm extremely bullish on this company over 5, 10, 20 years. As of all these companies I covered here, these ones in red, again, it's not about anything negative about the company, and these are long-term investments for me that I think are going to be highly profitable and make me a lot of money over the long term. This is just about positioning my portfolio over the short term, and so take that for what it's worth. All right, and last one, the 10th largest position in my portfolio is Pinterest, ticker PINS. They're considered a social media play, but they're really more a do-it-yourself DIY inspiration platform where people go to get inspiration for home projects. And then they're building in advertising into their platform and e-commerce directly into their platform as well. And my 10th largest position at 4.7%, basically a full position, down about 18% the past 5 months, kind of trading sideways. And really right now it's kind of at the bottom end of that range it's been in. And currently at 13.9 times sales with a forward PE of 40.7. Given the 55% growth rate, I think that's reasonable. It's not cheap, but I think that's a reasonable valuation. So I'm not really looking to add or trim at these levels. I have a built out position and I think it's appropriately valued at these levels. So I think I'm just gonna wait for long-term share price appreciation and pins. And I think we'll see this as a higher portion of my portfolio as that share price rises. So there you have it. 3 or 4 of the companies in my top 10 holdings have made big moves to the upside over the last 5 or 6 months or so, and they're also trading expensive. So there might be some opportunities there for me with continued strength to potentially trim a little bit off some of those positions. By no means does that not mean they're very high conviction companies for me to hold over the long term. They're still going to be core positions for me. It's just an opportunity potentially to raise some cash. I had a really strong cash position at the beginning of 2021. It was around 20% or so. And then I started really aggressively buying some of my core holdings as they sold off around March through the summer months. So I was doing a lot of buying and depleted that cash reserve pretty quickly. And I plan to deploy a bunch of new capital into the market recently through a refinance of our 2 properties that we own that I did recently. But we ultimately decided to buy a property with that money. So I don't have any additional capital to put into the market at this time. So I want to use the opportunity of some of these companies that have been performing really well and trading at high valuations, potentially take a little bit off the table to build a bit of a cash reserve back up so I can take advantage of any broader market weakness. And then also if we see any of these individual core holdings drop 20% or more from their current levels, the ability to actually add to those positions. So doing the opposite, especially if I take any profits or trim any of these companies, I still have really high conviction in them. If you see a bit of a pullback, I'd be definitely looking to add back those shares that I took off the table. But I like to lock in some of those profits on some of these names that are moving incredibly quickly. That strategy of working around a position, so taking a little bit off the table and trimming when I have really big outsized returns in a particular stock in very short amount of time, or when they reach over that 10% weighting in my portfolio, and then looking to add back when we see 20% or more sell-offs in those names has worked incredibly well for me over the long term. Well, that was a lot in today's video. I hope you got something out of it. Part 2, I'll be covering positions 11 through 22. Thanks for watching.